I want to talk to you about trading stocks and options and the importance of being a self-directed trader and investor. Now, whether you have a brokerage account and you're already trading completely on your own, or maybe you haven't even made your first trade yet, regardless of your stance and where your positioning is, you have to listen, because the game of investing in the stock market and the business of trading has changed completely. With technology moving faster than ever and all of the readily available information, it has never been easier to gain the knowledge and the tools necessary to navigate the markets like a professional and build a successful long-term business that can stand the test of time. Hello, my name is Tyler Shanelli and I am the founder of Option Trading Coach, and I'm here to tell you that the game of investing in the business of trading has changed, and it has changed for the better. And I'm excited about that because the last few years we've formed a new era in trading, and this business has migrated from the old-fashioned trading pits on the exchange floors to a more electronic, computer-based business, as you can see, that has the technology behind this, the shift, really the technology behind the shift that's made the stock market and the trading business more transparent than ever. And it's given the retail traders, people like you and I, the ability to finally have the same level playing field as everyone else out there. It's also lowered the cost for the retail trader to execute trades and to grant us the access and the real-time data that's needed to make the right decisions. And now with all these profound technology advancements, we have the same robust trading platforms and software systems that used to only be available for professional trading firms and institutions. And that alone is absolutely huge, because now we have everything that the pros used to have, and that's the type of transparency that we need in the stock market for the retail traders like us to have success for consistently over the long term. And with all the negative news surrounding this business and the stock market, with dishonest trading practices and scams and people losing a fortune because they have maybe a bad broker or some type of corporate scandal, or even companies like Bear Stearns and Lehman Brothers going out of business in 2008, all of that negative connotation has created a difficult and put a bad taste in people's mouths. That's why the education and the knowledge is so important, so you can navigate around all that noise, learn the tools, learn the strategies to have consistent success in the stock market. And I get excited about that because I'm about to show you a very effective trading strategy that you can use to bring in income on existing shares of stock that you might own now, or maybe you own in the future if you're not trading yet. So doesn't that seem interesting to you, to learn how you can consistently produce income on your stock investments? Because with this business, as it evolves, when you have the ability to have complete control over your success or your failure, then you're going to be able to make the right decisions. And the lack of education, that is what leads to financial suicide. And the longer you wait to get thoroughly educated, the more daunting this task is going to become, and it's going to seem more impossible for you to get in the game. And that's why I want to tell you that the longer you wait to get educated, the more vulnerable you're going to become with any of your current financial investments, as well as losing out on your opportunities, which is going to be your lost opportunity cost, because there's going to be some great trades and some really powerful trends that are going to occur over the coming months and years ahead. And I can tell you that from my 15 years of market experience I've gained in this business, the main thing that separates the novice trader from the professional trader is the strategy. So in a minute here, I'm going to show you and walk you through a trade example on one of the most prevalent stock and option trading strategies, known as selling a covered call. So whether you own thousands of shares of stock or you have yet to open a brokerage account and make your first trade, this strategy of selling a covered call is something that you can use in any type of market, up, down, or sideways, to bring in consistent income. So whether you're trading stocks as a self-directed trader for years and you want to maybe hone your skills and get better at doing what you're doing now, or maybe you're just getting your feet wet in the stock market, it doesn't matter, because this trading strategy is something that also works in non-margin IRA accounts. So it's a very vast, group out there that this can help you with, and that's what the whole goal is for me, is to help give you the leverage, the knowledge to increase and compound your investment returns. And when you learn this and you start, having the knowledge and the ability to apply this and use it, you can do something. You can do this every single month, and you can start, fine tuning and honing your skills as it fits your personal risk profile and your style of trading. That can also, yield consistent income for years to come. So Let's go ahead and dive right into that trading demonstration, and I'll show you exactly how this strategy works right now. Welcome to Selling Covered Calls, and this is how you produce income on shares of stock. I want to run through some of the principles before we do the live demo, so let's go ahead and jump in. Selling a covered call only works if you have 100 shares of stock or more, because one option contract, which is the minimum and the lowest quantity you can do, is standardized to 100 shares of stock. So if you had 99 shares of XYZ stock, you cannot do this strategy because you have to have 100 shares or more. So if you had 200 shares of XYZ stock, then you could sell 2 call options or 2 covered calls. The second one is it gives someone else the right but not the obligation to buy your stock at the strike price at which you sold. So for example, if you own 100 shares of Apple at $100 a share and you sell a 110 strike price option, think about that. You're giving someone else the right but not the obligation to take Apple from you at 110 a share, and they pay you that premium, which is called your covered call premium. And also, selling a covered call is typically done for 1 to 2 months out because the option premium and the decay in those specific time frame is the richest. So if you're going into a covered call trade, you're going to get the most bang for your buck. And it's the smartest way to do this is because options that are 10 to 40, 50 days out, it's kind of, think of it like a bell curve, and as you get closer and closer to expiration, it's just like a piece of paper, kind of like a fire, because options are decaying assets. So you want to sell the closest time frame possible, because every day that passes, you're going to be producing income. Because as a seller of options, you kind of have to flip the mindset. As a seller of options, since options are decaying assets and you're selling a decaying asset, every day that gets closer to expiration, you're going to be able to get that premium kept, and it's going to expire worthless, which is the goal of this strategy. The next one is that covered calls work best in a sideways or a slow trending market, because if you think about it, you're giving someone else the right to buy your stock from you at a certain strike price. And if that stock, we were talking about Apple, you own it $100 and you saw 110, if Apple goes to 130 and you lose that $20 upside, I said $20 upside because you sold a 110 call option, you cap yourself. So you're not going to be able to make that extra $20 share profit that you would have had if you didn't sell the covered call. So this strategy is not something that you want to use in a strong uptrending or downtrending market, because it wouldn't make sense. And the last one is that your brokerage account has to be approved for level 1 options trading in order to sell a covered call. So there's 5 levels of options trading, and this is the most basic. This is very simple to do. You're actually allowed to do this in your retirement account or your brokerage account, and it's very prevalent. So if you own maybe a multitude of stocks in your retirement account that maybe aren't doing anything and they have options listed on them, you have the ability and the right to sell covered calls on them and bring in some income on that. So you do have to have level 1 options approval to do this strategy. So now I want to give you the live demonstration on producing income with stock by using the covered call strategy. So I'm going to break this down, and this is kind of a complex slide, so I'm going to try to go as slowly as possible and explain each aspect in depth so that you're following me all along. So right here we got Investor Bob. Investor Bob owns 100 shares of ABC stock at $15 a share. That equals a $1,500 investment. Pretty simple math there. And this right here is a snapshot, the current price structure and all the data surrounding ABC stock. And this is a live example that I took out of a brokerage account so that it's very accurate so that you can follow along. Is basically, right now looking at this ABC stock, it's trading at $17.67. That's called the last price right there. The net change, that's how much the stock went up or down on that specific day. And this day it went up 1 cent. The bid, that's the price at which you sell. So if you wanted to sell your 100 shares, then you'd sell it at $17.62, and you'd make a nice little profit of roughly $262 minus commissions. And then the price over here, the ask price, that's the price at which you wanted to pay. So if you wanted to buy another 100 shares, you wouldn't buy at the bid price, you would buy at the ask price, which is $17.99. The next one over here is the size. That's kind of basically a market maker term that you don't have to worry about. They're saying they want you to buy at least 1 times 7 shares, so it's 7 share minimum, which is completely void. Don't worry about that. The volume, though, that's very important because that's telling you how much activity or how many shares were traded on a specific day. So this day, it was 12.5 million shares traded, which is a lot, and that's considered very liquid. So over here you have the open, that's the price at which ABC stock opened for that day. And then the high was 17.89, that's the highest it was the day trading up. And then the low was the lowest it traded. So you can see there was about an 80-cent fluctuation, a 70-cent fluctuation in that specific day time frame. And then it opened at 17.56 and it closed at 17.67. So kind of was around the board a little bit for about 70, 80 cents and closed right around the middle. So that's kind of a good example on a daily time frame of something that's not really trending strong. It's kind of in a sideways trend, not really, moving large moves up or down. And that's what you want when you're doing the covered call strategy. So over here now, this is where we're going to get a little more advanced, and please follow along as closely as possible. So right here, this is a 1 month option chain, and these are the calls because this is a covered call strategy. So we're looking specifically at the call options on ABC stock. Now, these are all the columns of the option chain. So I'm going to talk through each column and explain how you would pick the strike price and the expiration that's relevant to your specific stock that you own. So if you own 100 shares at $15 a share, and it's a $1,500 investment, and the stock's up to $17.67, you're up roughly $267. You could sell it and take the profit, or if you like the stock long term and it's maybe just moving a little sideways and you want to generate some income, then this is where the selling the covered call comes into play. And this is what you would look at. That's the data you look at to determine which strike price and which expiration you want to choose to sell. So you have the implied volatility, the probability of expiring in the money, which we're going to talk about in a minute, the open interest, the bid, the ask, the expiration, and the strike price. And there's a lot more strike prices than this for every option, but you really don't have to worry about that, because what you want to worry about is what are the strike prices that are closest to the current stock price. So the current stock price is $17.67. $17.67 is right in this range, right in the middle. So these are all the options that have, interest and value, and those are the ones that you want to be involved with. And for this example, when you're selling a covered call, in the last slide, you want to go from 1 to 2 months out. That's the time frame. And then also you want to be able to sell something that's relatively close to the current stock price, because you're going to get your most bang for your buck when you sell what's called an at-the-money call option. So the at-the-money call option here would be considered the $18 strike price. Why the $18 strike price? Well, the stock's trading at $17.67. The $18 strike price is basically the closest dollar amount, or the closest, number to $17.67. You also have 17, but guess what? Is $17.67 closer to 17 or 18? 18. Thank you. So now 18 is what you would use as your gauge, as your starting point. So the starting point here means, okay, I own 100 shares of stock. Stock's moving kind of sideways. How can I bring in some income? Well, I think I like the $18 strike price because it's the closest to $17.67. I'm going to get the most bang for my buck, and I'm going to be able to do so because these options right here, this 37, that's the last element I want to explain. That's how many days are left on this specific chain before they expire. So you have 37 days till expiration. The implied volatility is basically how overvalued the options are. So with a 49 or 48% volatility, you're getting a pretty good premium for your money. And then over here, the probability of expiring in the money, that's an advanced option term, meaning, if a stock is basically, if an option is basically in the money, it means it has intrinsic value. Now, intrinsic value is a fancy term that is correlated with options, and it means if you have a $17 strike price option and the stock's trading at $17.67, the $17 and the $17.67, that's considered in the money because of the 67 cents above the strike price. So 18 is not in the money, it's considered at the money. The $19 strike price is considered out of the money. So you can see that as you go deeper, lower in the strike price, those are going to become deeper in the money. the deeper in the money, the more expensive the option because of the intrinsic value. And if you think about it, if you have a $15 strike price option and the stock's trading at $17.67, you have the right to buy that stock at 15, and then you can go out and immediately sell it $17.67. That's $2.67 in intrinsic real value that's there. And then if of course these numbers change when the stock changes, but to get your mind around it, and if this is the first time you've been exposed to this, just stay with me because it's going to get easier as we move forward. But the real takeaway here is when you're selling a covered call, you're going to get the most bang for your buck at the money, which will be the $18 strike price. So in this example, we're going to sell one 18 strike price call option for 95 cents. 95 cents is the mid price on the 18 right here. I'm going to kind of zoom in right there. And you can see that 94.96, that's the bid ask, and 95 is the mid price, and that's the price that you're going to get filled at. That's called the theoretical price. So that's how that works. And you have 7 days to expiration. The probability in the money, that means it's a 42% chance that this option is going to be in the money. So that means there's a 60% chance, because I'm taking the inverse of that, there's a 60% chance, actually a 59% chance that this is going to expire worthless. So when it means a 41% chance in the money, that means there's 41.9% chance that it's going to be at or above $18 by expiration. And that's important to know because you have the odds in your favor when you're selling an option contract that has a 60% chance of expiring worthless. And guess what? If you went out to the 19, you don't get as much credit or much money, but now you have a 70% chance of expiring worthless. So it's important to understand that these probabilities, they help guide you and help give you direction on which strike price to choose, and use the mathematical formulas that are already built in for you, so you just know to have the structure there, which is what I'm for, to kind of show you the way, because I've been doing this for 15 years, and just follow something that works. And this is a perfect example of a way you can produce income on your shares of stock. Again, you have to have at least 100 shares to sell one contract. If you had 500 shares of ABC stock, you could sell 5 call options and you would bring in more credit. So to kind of bring this all together and do a recap, we brought in $95 of covered call income. The total stock value was $1,750, and I kind of rounded that down because the last price is $17.67. So I figured for easy math, $1,750 times 100 shares is a $1,750 stock value. You divide the covered call income into that stock price value, and you get a 5.4% return on your investment. And this is not over a 1-year period, because a lot of people think, if I can make 5% on my money in a year, that'd be great. But this is 1 month. So you can do this month after month, and not every single month is going to work perfect. There's pretty much 3 outcomes that happen right here. And the 3 outcomes are, number 1, the stock stays kind of flat and the option that you sell for 95 cents expires worthless. You keep your shares and you do the same thing the next month. Number 2 is the stock goes higher than 18 and you get what's called out of your stock. You get called out of your stock. Okay, well, you made a profit. You already bought the stock at $15, so you get called out at 18. You make $3 there. That's $300 plus you keep your premium. So you're getting called out. You're still making $395 on a $1,500 investment. That's a pretty good return. And then the third potential outcome is if the stock price falls. Say the stock price falls to $15 and you're back at break even. Guess what? Could be worse because you sold that covered call. At least you mitigated your downside risk by bringing in an extra $95. So you can kind of at least see the 3 scenarios. They're all pretty good if you weigh them out together, because yeah, you can lose some upside potential if the stock went to 20 or 30, but from a probability standpoint, that doesn't happen very often. And to be consistent, to have ongoing success in the stock market, you want to put the odds in your favor, use the mathematical probabilities to choose the right strike prices and have the right system and strategies and kind of, the overall plan as we have here to do this month in and month out. Now, in the next video, we'll be talking about how you can use the same strategy, but instead of using the selling a covered call on shares of stocks, we're going to be selling calls on LEAPs, which are long-term equity anticipation securities. And this is going to be a very informative and valuable lesson, so please stay tuned. And in the meantime, if you have not done so already, please feel free to download my 10-page report on the top 10 secrets of a professional trader. So I would really appreciate it if you could leave a comment below with any questions or comments or feedback that you might have. And I promise I'll be reading every single one of those and answering each one of you. So I look forward to sharing my knowledge with you, and I will see you on the next video.